Ever heard that diversifying is a good idea when you start out to invest? Well, ETFs are all about that. Hey there, in this video I'll break down exactly what an ETF is, why it can be important, some pros and cons, and everything you need to know about it. So let's get into it. What is an ETF? ETF is short for Exchange Traded Fund. So an ETF is basically a basket full of many single stocks or securities that trade on an exchange, just like a single stock. So you can purchase this basket from a company like Vanguard or iShares, and it will already consist of a bunch of stocks inside that they professionally handpicked to make part of this package. So why are they important? Well, they offer the opportunity to diversify your portfolio by investing into many different stocks at once, without having to buy each stock individually. It makes investing a whole lot simpler and time efficient. Let's say you want to invest into the energy sector. It would take many hours to do the research on which stocks to buy in the sector, and if you are making the right calls. But by rather doing a little research on an ETF that is energy sector specific, you'll be investing in a package that contains most of the best performing companies already without too much time invested. So the point is, ETFs can really be a great tool to use when you are starting your investment journey and not sure which single stocks to pick and don't want to do all the research about a specific single stock. Alright, so let's look at some pros and cons about ETFs. First, let's start out with the pros. The first reason, risk management through diversification. By having an ETF package that consists of many different stocks, you are less likely to lose everything when a certain company or market crashes. Therefore, it gives you the option of lowering your investment risk. The next one, because ETFs are managed as a package, the expense ratios are lower and there are fewer broker commissions. The third one, you have access to many stocks across various industries. Again, this gives you the ability to lower your risk. For instance, you can pick an ETF that consists of shares in the technology industry as well as the automobile industry. This enlarges diversification and will make it much harder for you to lose everything in an instant. Alright, the last pro, ETFs exist that focus on targeted industries. Therefore, you can be diversified but industry specific. For instance, you can buy an ETF that is only consistent on the automobile industry, but because of diversification, you will not only hold shares in Ford, but in all different car companies like Toyota, Chevy, BMW, etc. So as I mentioned above, ETFs are great because it will save you a lot of time when building an investment portfolio. Alright, so let's look at some cons. So the first one, actively managed ETFs have some higher fees, obviously. And the next one, single industry focused ETFs limits diversification and might enlarge your portfolio risk. So let's quickly look at ETFs versus single stocks. It's important to note that ETFs are usually the slow and steady way going forward and not the get-rich-quick scheme mostly. For instance, let's say you invest $1,000 solely in Apple stocks. Apple invents some new kind of technology and their stock price rises 30% in one day. You would have made $300 within a day. The opposite can also happen. Apple could have a major drawback in their company and the stock price drops by 30%. Now you would have lost $300 in quick time. With an ETF, one of these scenarios are likely to happen. If one stock within your ETF basket does jump significantly, it will increase the value of your ETF, but not nearly as much if you only invested in that one single stock that jumped. The same is true in the other direction. A stock that has a major retracement will not impact your ETF value too significantly at all. Alright, and the last point that's important to touch on is the trader versus investor. I think I will make another video about this specific topic in the next couple of weeks, but just a quick word on this. It's very crucial for you to distinguish early in your journey if you are an investor or if you are a trader, because to jump around from the one to the other might be dangerous for your investments. An investor is generally someone who invests into the market for the long term, 10, 20 or 30 years. Therefore, market fluctuation generally doesn't influence an investor to sell and buy on a short-term basis, but always making decisions within his or her portfolio for the long haul. So a trader is generally someone who buys and sells stocks on a daily basis to gain profits regularly. This is not really easy and in most cases a full-time job. It can really hurt your investment to find yourself being an investor and making short-term trades in market fluctuations. Therefore, it's a good idea to solidify your position, investor or a trader. I am personally more a fan of ETFs, and they generally make up the biggest portion of my stock portfolio. The pros just outweigh the cons for my specific investment goals. Alright, I hope that you have learned something in this video. This is Mind Leaves and my name is Minika. We usually talk about freedom, finance and purpose, so if you're interested in more content like this, feel free to subscribe down below. And thank you for watching. I will see you guys in the next video.